Imagine a financial landscape so baffling it defies conventional logic. On one side, the bedrock of global economic stability, the Federal Reserve, faces an unprecedented crisis. Its chairman is reportedly under threat of criminal prosecution. This stems from congressional testimony scheduled for June 2025. Yet, at the very same moment, the Dow Jones Industrial Average and the S&P 500 soar to all-time record highs. They seem to mock the notion of instability. How can these two irreconcilable realities coexist? Is the market simply detached from reality? Or is there a deeper, more sophisticated game at play? Today, we will piece together the scattered fragments of this bizarre phenomenon. We will reveal the profound contradictions defining our current economic moment. We will illuminate what it all means for your portfolio and your future. This isn't just about economics. It's about understanding the silent, seismic shifts happening beneath global capital. Let's rewind to truly grasp the audacity of this situation. The direct revelation from the Federal Reserve Chairman, a figure commanding immense gravitas, isn't just a headline grab, it's an earthquake. His announcement that he is under threat of criminal prosecution strikes at the very heart of central bank independence. This principle is foundational to global economic stability. It is almost sacrosanct. This isn't some minor regulatory skirmish. It's an institutional integrity crisis. It could send tidal waves across every market, from Tokyo to London, from New York to Shanghai. The idea that the most powerful financial official in the world could face such a fate casts a chilling shadow on the stability of the entire system. Naturally, the immediate reaction was nothing short of pandemonium. Financial channels buzzed with a singular panicked refrain, "Sell America!" Investors, gripped by primal uncertainty and rational fear, instinctively began liquidating positions. This wasn't nuanced deliberation. It was a visceral flight from perceived risk. Equities plummeted. Bonds, usually a safe harbor, also saw significant outflows. The very notion of American stability, the linchpin of global finance, seemed to wobble. It was a classic risk-off scenario, amplified to an 11. This signaled a profound loss of confidence in the political and institutional structures underpinning the world's largest economy. For a fleeting, terrifying moment, it felt like the floor was falling out from under everyone. Then, just as quickly as it plunged, the market executed an astonishing reversal. The same indices that had been drowning in red ink not only recovered all their losses, but surged past them. This culminated in fresh, shiny record highs for both the Dow and the S&P 500. It was as if the market collectively shrugged, wiped its brow, and decided the crisis was simply not their problem. This wasn't merely a simple buy the dip phenomenon. It wasn't the kind of opportunistic bounce sometimes seen after a sharp correction. Oh no, this rebound defied explanation. It flouted convention. It practically demanded a deeper dive into the intricate psychology of today's hyper-aware investor. It felt less like a recovery and more like a defiant roar. A declaration that something else entirely was driving the engine of global capital. The market's defiant roar wasn't a sign of irrational exuberance. It was a profoundly sophisticated, almost covert maneuver. What we witnessed was not a wholesale abandonment of the American experiment. Instead, it was a highly calculated Hedge America strategy. It's crucial to distinguish between selling out of fear and hedging against specific risks. When news of the Federal Reserve Chairman's potential prosecution broke, many interpreted the initial market dip as a lack of faith in the fundamental economic strength of the United States. They assumed investors were throwing in the towel, pulling their money out en masse. They were convinced the world's largest economy was suddenly too volatile, too politically compromised to be a safe bet. But that's where conventional wisdom missed the mark entirely. Imagine a seasoned sailor navigating treacherous, storm-tossed waters. Does that sailor abandon ship the moment waves get high? No. They batten down the hatches. They furl the sails. Perhaps they even deploy a sea anchor. They are not leaving the vessel. They are prudently insuring against very specific, anticipated political squalls. They maintain an unwavering, almost stubborn confidence in the underlying seaworthiness of the ship itself. That ship, in this analogy, is the United States economy. Investors were not abandoning the market. They were, with surgical precision, purchasing an insurance policy. They were building a protective layer against unforeseen political turbulence. This was a clear sign of financial insurance being purchased, not a declaration of economic surrender. This wasn't about a loss of faith in fundamental economic strength. It was about compartmentalizing risk. It separated the robust economic engine from the unpredictable political landscape. The evidence for this Hedge America strategy is remarkably clear, especially when we look at fixed income markets. Amidst the initial panic, many expected a massive sell-off in U.S. Treasury bonds, a flight from the supposed safe haven. After all, if the very foundation of central bank independence was cracking, wouldn't the perceived safest asset in the world lose its luster? But something quite different happened. Data revealed that foreign investors, the very entities you'd expect to be most skittish about institutional instability, significantly increased their holdings of U.S. Treasury bonds last year. Think about that for a moment. As political storm clouds gathered, as the specter of prosecution loomed over the Federal Reserve, global capital flowed into the safest assets backed by the U.S. government. This wasn't divestment, it was a strategic allocation. These sophisticated players were not fleeing, they were fortifying. They were taking advantage of the initial dip in bond prices. They viewed it as an opportune moment to pile into assets that traditionally perform well during times of uncertainty. U.S. Treasuries, despite any political noise, are still universally regarded as the ultimate safe haven asset. They are backed by the full faith and credit of the U.S. government. It's the financial equivalent of building a bomb shelter in your backyard. Not because you're abandoning your house, but because you want to protect your family from a specific external threat. Foreign investors were not betting against America's long-term economic viability. They were betting on the resilience of its financial architecture to weather short-term political storms. They were securing a protective layer, not abandoning the whole structure. Simultaneously, these astute investors executed a remarkably shrewd dual strategy on the equity side. While building their robust insurance policy with fixed income, they viewed any market correction spurred by political noise as a prime opportunity. An opportunity to acquire high-quality equities at a discount. The initial "Sell America" reaction, fueled by fear, created a temporary fire sale. For those with a longer-term perspective and a clear understanding of the difference between political drama and fundamental economic strength, this was an irresistible invitation. They were not just buying the dip, they were strategically accumulating shares in companies with strong balance sheets, innovative technologies, and dominant market positions. They believed these companies would continue to thrive, irrespective of who occupied political offices or what controversies embroiled the Federal Reserve. Consider the dynamic. On one hand, a protective layer of safe haven assets guarded against worst-case political scenarios. On the other, an aggressive accumulation of growth assets capitalized on temporary price dislocations. It's like a shrewd chess player. While defending against a known threat, they simultaneously use that defense to open new offensive opportunities. They were carefully managing political risk by building a robust insurance policy. They were concurrently capitalizing on dips as rare chances to accumulate wealth in what they perceived to be a fundamentally resilient economy. This wasn't panic. It was calculated, strategic action, a masterful display of risk compartmentalization and long-term conviction. The market's astonishing rebound wasn't an act of defiance against reality. It was the ultimate expression of this sophisticated Hedge America strategy playing out in real time. Now, If the increase in U.S. Treasury holdings served as a sophisticated hedge, then the explosive ascent of precious metals provides an even more visceral indicator of this underlying anxiety. While equities were soaring and bonds were being accumulated, gold and silver, the ancient guardians of wealth, also rocketed to unprecedented levels. Gold breached $4,600 per ounce, an all-time record. Silver, often considered gold's less glamorous cousin, defied historical norms. It reached its own all-time record highs. This wasn't just quiet accumulation. It was a loud, undeniable roar from a significant segment of the investing public, a manifestation of what we might call primal fear. Societe Generale's astute analyst, Michael Haig, encapsulated this sentiment perfectly. He stated, "Elevated uncertainty directly impacts the gold market." He wasn't just talking about economic uncertainty. He was referring to a palpable distrust in political and financial institutions, a deep-seated concern that the traditional pillars of stability were beginning to crack. Gold, throughout history, has been the ultimate store of value when trust erodes. It's the asset you turn to when you fear that governments might print too much money, or when the rule of law seems shaky, or when the very independence of a central bank is called into question. Its record high wasn't a random event. It was a direct response to the unprecedented crisis engulfing the Federal Reserve. A clear signal that a significant portion of capital was seeking refuge in tangible, apolitical assets. But the story of silver's meteoric rise is even more telling. Gold surged 64% last year, a truly remarkable performance by any standard. Yet silver, with its significantly smaller market size and higher volatility, rocketed an astounding 146.8% during the same period. Think of silver as a more sensitive barometer, a financial Geiger counter for acute market uncertainty. Its dramatic spike indicates not just general unease, but a profound, almost desperate flight into physical assets. When silver, a metal with significant industrial demand and a long history as a monetary asset, outperforms gold by such a margin, it signals that the fear premium is not just high, it's off the charts. It suggests a strong belief that the current economic and political landscape harbors risks that extend beyond typical market fluctuations. This creates a fascinating, almost paradoxical, dual investment dynamic. On one hand, investors are engaging in aggressive stock market shopping. They view dips as irresistible bargains. They are confident in the long-term prospects of innovative companies. They are betting on the future, on technological progress, on the resilience of the American economy. On the other hand, these very same investors, or perhaps a different cohort with equally strong conviction, are simultaneously filling their vaults with physical assets. They are building what amounts to a financial ark of precious metals. It's a striking contradiction, a vigorous pursuit of growth coexisting with an urgent, almost survivalist accumulation of safe havens. This powerful surge in precious metals, far from abating, loudly proclaims that beneath the surface of apparent market strength, a significant portion of capital is actively preparing for contingencies. It's not a subtle nudge. It's a bold declaration that a robust Plan B has been activated. This isn't just about hedging. It's about insurance against systemic risk, against a complete breakdown of trust in paper currencies or financial institutions. The message is clear. While the stock market soars on the wings of innovation and perceived economic resilience, a deeper, more profound concern about the stability of the global financial architecture is driving massive capital flows into gold and silver. It's the sound of capital, discerning and cautious, meticulously activating a robust Plan B, building a financial ark of precious metals, just in case the ship of state hits an iceberg. This simultaneous movement into seemingly contradictory assets underscores the complex, multi-layered risk assessments made by sophisticated investors in this extraordinary time. Amidst this intricate dance of hedging and frantic safe haven accumulation, one sector stands out with almost defiant brilliance: artificial intelligence. At the epicenter of this AI revolution is Google's parent company, Alphabet. While the Federal Reserve wrestled with existential threats and global investors debated the merits of gold versus treasuries, Alphabet quietly, almost imperceptibly, joined an exclusive club of companies. Alongside NVIDIA, Apple, and Microsoft, it surpassed a staggering $4 trillion market capitalization. $4 trillion. Let that number sink in. It's a valuation that seems almost immune to the chaos below. It is a testament to a belief that the future of technology, specifically AI, transcends mere market fluctuations and political drama. This isn't just a company growing, it's a new titan, solidifying its place at the pinnacle of global capital. The catalyst for much of this recent surge, particularly for Alphabet, was a groundbreaking partnership with Apple. In a move that sent reverberations across the tech world, Apple announced it would be integrating Google's Gemini AI model directly into Siri, its ubiquitous voice assistant. This wasn't merely a collaboration, it was a tacit, yet profound, acknowledgement from one titan to another. An acknowledgement that Google held a distinct and formidable advantage in the escalating AI arms race. For Apple, a company fiercely protective of its ecosystem and brand, to integrate a competitor's core AI technology spoke volumes. It was a resounding victory for Google in the battle for AI dominance. A public declaration that, despite its own considerable AI efforts, Apple recognized Google's Gemini as providing the most capable foundation, as Apple's official statement put it. This partnership didn't just boost Alphabet's stock. It fundamentally altered the perception of who was leading the AI charge. It solidified Google's position as the undisputed frontrunner. And then, as if the market needed any further validation, legendary investor Warren Buffett made a rare and significant move to acquire Alphabet shares. Buffett, the Oracle of Omaha, built his empire on understanding intrinsic value. He famously avoided speculative bubbles. Investing in a leading-edge AI company? This wasn't just another institutional investment. It was the ultimate stamp of approval. It endorsed Alphabet's long-term value, its undeniable dominance in the burgeoning AI market. It signaled a universal agreement, even among the most conservative investors, that an irreversible, transformative paradigm shift was underway. Buffett's investment wasn't a bet on a fleeting trend. It was an acknowledgement of a fundamental, structural change in the global economy, a change driven by the relentless march of artificial intelligence. It declared that AI, as embodied by companies like Alphabet, was not just a speculative play. It was a foundational investment for the next generation of wealth creation. To truly understand Alphabet's defiant rise, we need to briefly touch on the underlying forces driving this AI revolution. It's not a single breakthrough. It is the convergence of three colossal gears, each turning with unprecedented power, engineering the most potent force in human history. The first gear involves revolutionary algorithms. Think of models like the transformer architecture for generative AI. It underpins much of what we see in large language models. These are not just incremental improvements. They are paradigm shifts in how machines learn, process information, and generate content. They allow AI to understand context, to generate human-like text, to create images, even to write code, moving us beyond simple pattern recognition into the realm of true intelligence emulation. These algorithms are the intellectual blueprints, the very thought processes that enable AI to perform increasingly complex tasks. They do so with astonishing accuracy and creativity. They are constantly evolving, becoming more efficient, more capable, and more expansive in their application, pushing the boundaries of what was once considered science fiction into everyday reality. The second gear is the unprecedented torrent of data. Every click, every search, every social media interaction, every sensor reading from our increasingly connected world contributes to an unimaginable ocean of information. This vast data deluge is fueled by the widespread adoption of the internet and smartphones. Coupled with plummeting storage costs, it provides the essential fuel for AI algorithms. Without massive data sets, even the most sophisticated algorithms would be starved. This data is the raw material, the learning experience that allows AI models to train, to refine their understanding, to constantly improve their performance. The more data they consume, the smarter they become. This creates a virtuous cycle of improvement that is accelerating at an exponential rate. It's the difference between a student with a single textbook and one with access to the entire Library of Congress. And the third, arguably the most powerful gear, is the raw processing power provided by the GPU engine. NVIDIA, with its CUDA platform, has dominated this space. It essentially became the picks and shovels provider for the AI gold rush. Graphics processing units, originally designed for rendering complex graphics in video games, proved perfectly suited for the parallel processing demands of AI model training. Their ability to perform countless calculations simultaneously is what makes it possible to train models with billions, even trillions of parameters in a reasonable time frame. Without NVIDIA's relentless innovation in GPU architecture and software, the current AI boom simply wouldn't be happening, not at this scale or pace. These GPUs are the high-octane fuel and powerful engines. They transform algorithms and data into actionable, intelligent systems. These three colossal gears, revolutionary algorithms, unprecedented data, and powerful GPU engines, are not just driving companies like Alphabet. They are engineering the most potent force in human history. This convergence explains why the market is willing to assign such astronomical valuations to AI leaders. Even as the traditional pillars of economic stability appear to wobble, it's a bet on an entirely new era, a belief that the AI revolution is an unstoppable, transformative wave, a wave that will reshape every industry. It will redefine productivity and create unprecedented wealth, making companies at its forefront seem bulletproof against mere political squabbles. The market isn't just embracing AI, it's placing its ultimate faith in its transformative power, viewing it as the ultimate engine of future capital. Now, while the AI giants seemingly stand immune, riding the wave of unprecedented innovation, it's crucial to understand that not every sector enjoys such a privileged position. The very political and regulatory risks that astute investors are hedging against with their gold and silver purchases are, in fact, directly impacting other, more established parts of the economy, particularly the traditional banking and credit card sectors. This is where the market's selective perception of risk becomes starkly apparent. It creates a landscape of profound winners and equally profound potential losers. The political gaze, sharpened by public discontent and election cycles, is shifting. It's landing squarely on areas perceived to be extracting excessive profits from ordinary citizens. Consider the existential threat that recently emerged for the credit card industry. President Trump, in a move that sent shockwaves through financial institutions, advocated for capping credit card interest rates at a mere 10%. To truly grasp the gravity of this, let's look at the numbers. In 2024 alone, consumers paid over $160 billion in credit card interest. Average rates often exceeded 25%. A 10% cap isn't a minor tweak. It's an immediate, brutal, and existential threat to the profitability model of an entire industry. It would fundamentally reshape how these companies operate. In many cases, it would wipe out a significant portion of their revenue. The market's reaction was swift and unforgiving. Capital One, a major player, plunged over 6% immediately following the announcement. Synchrony Financial, another significant issuer, saw its shares decline by over 8%. These were not minor dips. These were visceral responses to a direct, credible political threat. It illustrates that while some sectors soar on the back of future innovation, others remain acutely vulnerable to the shifting winds of regulatory scrutiny and political will. The market, in essence, is surgically identifying targets for its risk-off maneuvers, even as other segments enjoy unparalleled growth. Yet, even amidst this targeted pain and institutional instability, a broader look reveals a remarkable, albeit selective, market resilience. It's not a uniform boom, it's a patchwork of strength that underscores the complexity of our current economic moment. Many companies across diverse industries continue to exhibit robust performance. They seem unaffected by the turmoil at the Federal Reserve or the political threats facing the credit card sector. Consider some of these beacons of selective strength. Retail giants like Walmart and Ross stores have been reaching all-time highs. This indicates a resilient consumer base and efficient operational models. The semiconductor leader Micron Technology continues to soar. This reflects ongoing demand for crucial hardware that powers everything from data centers to personal devices. Even in the defense sector, L3 Harris Technologies and Lockheed Martin are reaching new highs. This highlights persistent global geopolitical tensions and robust government spending. And then there's Freeport-McMoRan, a copper mining powerhouse. It is trading at its highest level since 2011, a strong signal of optimism for future industrial demand and green energy transitions. This broad yet undeniably selective strength confirms a crucial insight. Underlying economic momentum, separate from political volatility, remains a potent force in many critical areas. It suggests that while political and institutional risks are very real and impact specific sectors, they are not universally derailing the entire economic engine. The market is not a monolith. It's a collection of distinct ecosystems, some thriving, some struggling, each responding to its own set of catalysts and challenges. It's a testament to the adaptability and innovation present across various industries, creating pockets of robust growth even as the broader financial landscape appears fraught with contradictions. This brings us to the defining question. It is the great pivot. Every investor and every individual navigating this shifting economic landscape must ponder it. We've seen the sharp blade of political and regulatory scrutiny. It is currently aimed at credit card companies and banks, threatening their very business models. But what if this blade were to pivot? What if it were to turn with the same intensity and purpose, and instead target the very tech giants that dominate the AI market? The companies like Alphabet, Nvidia, Apple, and Microsoft. The companies currently propelling this powerful rally? Is it not possible that the very engines driving this unprecedented growth today could become tomorrow's targets? The implications of such a shift are profound. It could redefine not just market leadership, it could redefine the very mechanisms of global capital allocation. Imagine a future where the regulatory environment for AI becomes restrictive, where antitrust concerns are amplified, or where governments impose limits on data usage or algorithmic control. This isn't a far-fetched notion. It's a familiar pattern in economic history. Dominant industries eventually face calls for oversight. Such a scenario could lead to a significant reevaluation of valuations for the tech behemoths, potentially dampening the AI revolution's immediate capital returns, forcing a redistribution of investment across different sectors. This ongoing tension between unfettered innovation and growth on one hand, and the imperative of oversight, regulation, and ethical considerations on the other, will undoubtedly be the defining economic battleground of the coming years. So how do individuals, not just investors, navigate this complex and potentially volatile future? In a world increasingly dominated by algorithms, by artificial intelligence that can perform complex tasks with superhuman speed and efficiency, the market value of what we call human edge capabilities is growing exponentially. These are the qualities that AI, at least for now, struggles to replicate. Critical thinking, the ability to analyze complex situations and form independent judgments. Creative problem solving, generating novel solutions to unprecedented challenges. Empathy, understanding and responding to human emotions and needs. Nuanced communication, articulating ideas persuasively and building consensus. These soft skills, amplified by a commitment to lifelong learning and continuous adaptation, are key to building an economic moat for personal competency against technological disruption. As the world transforms, our most valuable asset might not be our technical proficiency. It might be our uniquely human capacity to adapt, to innovate, and to connect. In conclusion, we find ourselves at a remarkable juncture, living through an unprecedented paradox. On one side, we witness the seemingly irreconcilable realities of unprecedented market highs, driven by the revolutionary force of artificial intelligence and a sophisticated Hedge America strategy, where investors are simultaneously buying growth and insuring against political risk. Yet, on the other, we see profound institutional instability, exemplified by the crisis engulfing the Federal Reserve and the direct political threats to sectors like banking and credit cards. The key takeaway is this: understanding these complex, often contradictory forces is central to making informed decisions. These include wealth-creating and wealth-preserving decisions. It's no longer enough to simply follow the headlines or ride a trend. Investors should watch how political and regulatory pressures evolve. Pay close attention to which sectors become targets and which remain insulated. Look beyond surface narratives. Think critically about risk compartmentalization, and deeply consider the great pivot question. If the focus shifts from traditional finance to the tech giants, the very dynamics we've observed could reverse. The market's current resilience might well be masking the seeds of future instability. Therefore, foresight is crucial. A commitment to understanding the interplay of technology, politics, and human behavior is also vital. Ultimately, adaptive thinking is essential. These are not merely desirable traits. They are, for your portfolio and your future, the most valuable assets of all.